I got to go back and pull this one up, but I thought there was a caveat that once you hit 59 and a half, I thought you could use it for almost anything non-qualified. Is that
You can because you can treat it like an IRA.
I think a lot of people overlook that.
Yeah.
And the nice part about this, regardless of your income, much like a 401k, contributions into it are fully tax deductible.
Right.
So it lowers that AGI. We like that. Yeah. It's just another incentive to save for retirement, for future healthcare costs, whatever it is.
Well, and oftentimes you'll see some employers will make a contribution if you participate in that plan. So that kind of comes into the calculus of what am I paying for premiums of my traditional plan versus my HSA? I kind of want to back out that number of that calculation because now you're getting, in a sense, free money.
Yep.
Yeah.
And yeah, it's one of our favorite accounts once people retire to go into retirement with, because it's just another IRA. It's another vehicle that you have to pull distributions from that you could choose to use, again, for healthcare or for everyday living expenses that you got a tax pickup or savings along the way while you're saving.
Exactly.
Cover that one?
Yeah. From there, we'd probably go straight to like 401k. Just make sure you're using it. Make sure you're getting a match. Make sure you're optimizing it. You know, there's like little nuances to know about now for retirees and pre-retirees. Well, for pre-retirees, pardon me, if you're retired, you don't care about your 401k anymore. But the main thing is that they tweaked the numbers on the catch-ups if we're in your early 60s.
Well, the nice thing, similar to an IRA, right? Once you hit age 50, you have your first traditional catch-up.
Right, which is
just
7,500.
Numbers change every year with inflation, give or take. But then I think what you're getting at was with passing in the newest tax legislation, one big beautiful bill. I think it's from, is it 62 to 65?
60 to 63.
60 to 63. I
do 1.5 times 7,500. So it's 11,250.
It is.
Yeah,
it is, which is interesting. And sometimes your plan will have an automatic provision that allows you just to kind of step up and fill that number to its fullest. But other times you got to search for it, talk to your payroll or HR to make sure you're hitting that number. But again, when we're on the topic of free money on the table and you're over the age of 50, or in this case, in your 60s, you may have a little extra that you didn't know about.
Yeah. I mean, there's some more nuances in there that we're not even going to dive into today. On catch-ups, it also has to do with your income level, on whether it's considered pre-tax or after-tax. But just know that you can do it, and it's worth looking into doing if you have the cash flow to do it.
Yeah, and then also with, 401ks, most employers now are providing two different avenues. A Roth 401k, which didn't used to be the case.
Right.
And now a pre-tax.
Yeah, it's commonplace.
Is that what that phrase is?
Yeah.
Yeah, I like that.
Yeah, commonplace.
Commonplace.
Well, but to add to what you're saying, another thing is if you guys have extra cash flow as you're kind of working toward retirement, a lot of plans year over year are now finally rolling out mega backdoor Roths.
That's a good one.
So you can actually, because we're talking about a normal contribution for you. The previous episode on this is what is it, 23,500 right now, and then 7,500 for a catch up. But the total number that you can put away between you, your employer, and not the catch up is something like $70,000.
Yeah.
So it's something to the effect of like 46,500 you could be putting into an after tax account and then converting it into a Roth if it's allowed. So just another thing for you to look at while you're doing your employee benefits and seeing like, is this something I want to do? And if this is too much for you, just reach out and we'll help you with it.